Michael Burry's predictions have all come true. The worst collapse in decades has now begun. Even the chart looks like a heart attack, but this is just the beginning of a much more terrifying crash. According to Burry, we're not even close to the bottom. There are 3 remaining factors that are going to cause America's collapse to be much worse than the 2008 recession. Michael Burry has sold almost all of his stocks because of these 3 reasons. You will be shocked at what he has to say. Thanks to Public.com for sponsoring this video, an investing platform that helps people be better investors, but more on that later. The first reason is that inflation is about to come back in a frightening manner. The Federal Reserve is adamant about raising interest rates to fight inflationary pressures. Fed Chair Jerome Powell recently announced a 75 basis point rate hike, or a 0.75% increase in interest rates. The Consumer Price Index, or CPI in short form, has been decelerating recently, meaning that inflation is slowing down. This is also known as disinflation, which is when the inflation rate slows down over the short term. It would be logical to assume that the recent disinflation is a result of the Fed's rate hikes, but Burry thinks otherwise. He believes that disinflation is a result of human behavior. Burry explained how inflation appears in spikes. When the spike is resolving, it won't be because of Biden or Powell. It will be because that is the essence, the nature of inflation. It resolves, fools people, and then comes back. When it comes back, neither the POTUS nor the Fed will take credit. Attached to the tweet is a chart that dates all the way back to the 1940s. The chart shows inflation going in cycles in the 1940s and the 1970s when inflation was prevalent. You can see how after the first inflation spike, there tends to be a second larger one. This is because during the first inflationary crash, the economy always collapses. This compels the government to start printing money again to start saving the economy. Unbeknownst to the government, inflation will come back roaring again in a terrifying fashion. This is due to a concept called the velocity of money. The velocity of money is the rate at which all transactions in the economy occur. This is measured by taking the GDP and dividing it by the money supply. For instance, let's say there was an economy that only transacted pizza. In this theoretical economy, 3,000 pizzas are sold in 1 year. If the price of pizza is $10, then we can calculate the total GDP by multiplying 3,000 pizzas by $10, or $30,000 in total. Let's say the total money supply is $10,000. To find the velocity of money, we need to divide $30,000 by $10,000 to get 3. The average US dollar was used in 3 transactions throughout 1 year, which is the velocity of money. While the money supply increased drastically over the past few years, the velocity of money hasn't picked up much until now. Burry warned, velocity is nominal GDP divided by money supply. Quantitative tightening and higher rates starting to push M2 down. Yet we are seeing a tick up in velocity, emerging from narrative obscurity. In 1978 to 79, rising velocity trumped falling money supply to drive inflation higher and higher. Redux would shock. Attached to the tweet is a graph showing the velocity of money in relation to the money supply. The white line shows the velocity of money, which has gone from 2.2 in the 1990s to about 1.1. This means that the average dollar is only transacted 1.1 times every year versus 2.2 in the past. You can see how recently, the velocity of money has started to pick up. If the velocity of money continues increasing, then inflation will be stronger than ever. Another graph that Burry attached showed the cyclical nature of inflation. In the 1980s, inflation came back roaring to over 15% year over year. Burry detailed this concept further by saying, realize inflation has always been peaky, and it never has been just one peak, so it resolves to a brief deflation or disinflation and comes back. An inflationary cycle generally spans years, and inflationary eras have spanned decades. Human nature. Attached to the graph was the CPI's year-over-year changes and the US GDP yearly growth rate. You can see how CPI and GDP growth rates are correlated. When the CPI goes up, the GDP tends to go up as well before crashing with the CPI. This means that as prices crash in the coming months, so will the economy. While the entire economy will go down, certain people will be affected more than others. There are 3 types of taxes: progressive, regressive, and proportional. The current federal income tax system is a progressive tax because upper income individuals pay the highest percentage of income tax. A regressive tax is when the lower and middle classes pay the highest percentage of taxes. The last type of tax is a proportional tax, where everyone pays the same exact percentage of income tax. Inflation is a regressive tax that affects the lower and middle classes the most. This is because the upper class has the most savings, which are usually invested in inflation-resistant investments like stocks and real estate. The lower and middle classes don't have that level of freedom, because most of their income is spent on consumer products and services. As consumer prices increase, the lower and middle classes' inflation-adjusted income will decrease. Burry explained why inflation is the worst kind of regressive tax. The cost of food at home has never risen this fast before. All of this is a result of the Federal Reserve's actions, and it's going to be their fault as the economy crashes in the coming months. Burry joked around by saying, "When something falls from the sky, it is not the fault of whoever put it up there in the first place, unless the Fed put it there." While the Fed is pulling back on spending, the fiscal government is still spending loads of money. New spending bills are being released left and right by the Biden administration. This is going to exacerbate the incoming inflationary wave. Burry explained how with recent spending bills, including the student loan forgiveness, now approaching $2 trillion this year, we have the emergence of the fiscal put, not just for COVID anymore, and will be as good for America's economy as sugar for babies. Burry's analogy of sugar for babies perfectly describes our current situation. When you give sugar to a baby, the baby will feel pleasure from the sugar. However, over the long term, the baby will want even more sugar, causing the baby's health to deteriorate. The fiscal government's actions are following the same trend. They have spent trillions of dollars, which boosted the economy in the short term, but will crash it in the long term. The economy will want even more money as a result, leading to a second inflationary wave. While the possibility of inflation coming back is a huge issue, there might be an even more serious problem. In July of 2022, the White House redefined what a recession is. One of the excuses for doing this was that the unemployment rate was still near all-time lows. The unemployment rate peaked at almost 15% in 2020, and has since dropped to roughly 3%. That's an extremely low rate that is historically bullish for the economy. If people are not getting laid off, then one can assume that the economy is still strong. That's a totally false assumption. The unemployment rate is a lagging indicator, which means that the rate lags behind a slowdown in the economy. So while the unemployment rate is quite low right now, it's bound to increase soon. During the employment bubble in 2021, the demand for white-collar employees exploded. Salaries for skilled labor shot up dramatically, and companies began offering work-from-home benefits. This graph shows the percentage of white and blue-collar employees working from home 10% or more of the time. After the pandemic started, the percentage increased to over 70% and hovered around that area. That is 4 times higher than the percentage for blue-collar employees at only 14 to 19%. Burry believes that the popularity of work from home is one of the main drivers of the employment bubble. When white-collar employees are working remotely, it's much easier to be unproductive since you can simply turn off your webcam. This has led to redundancies in the tasks that employees have. If everyone is unproductive, then multiple employees may be required for the same task. Burry believes this will all explode in front of our faces soon. He explained how the white-collar employment bubble is bursting right before our eyes. And the longer it takes the redundancy to disappear, the more permanent the decline in employment will be. Work from home will in time be seen as a culprit. So while the unemployment rate is still low, the longer it takes to rise, the worse the employment crash will be. Burry thinks that in retrospect, the employment bubble will be marked by the rise in work from home. The reason why this all matters is because the economy works in cycles. When one person loses their job, they will stop spending as much money. This is perfectly demonstrated by the circular flow model. The factor market and the product market are strongly correlated. One market crashing means that the other one will as well. The upcoming employment crash will be felt by the entire economy. But while employment is a serious problem, there's an even bigger concern: margin. What I like about Public is how they put investors first. Not only can you invest in everything in one place, from thousands of stocks and ETFs and over 30 different cryptos, but they don't sell your trades to market makers. Where Public really stands out is that you can now buy fractional shares of alternative assets on the platform. For the first time ever, not only can you build a portfolio that features stocks and crypto, you can also add contemporary art, blue chip NFTs, and other collectibles. In addition to being an all-in-one platform, Public does not give you standard market information and news. Through the app, you can access advanced data, custom company metrics, and expert analyst insights. It's great because you can see the metrics that matter most for the companies you follow. For example, say you want to track Netflix's latest subscriber growth, the number of Tesla vehicles delivered last quarter, or Apple's revenue broken down per product line, Public Premium makes it easy. You also get access to market insights from Morningstar, a leading investment research firm. In addition to the research and data on Public, you also have access to an interactive community filled with millions of investors, creators, and analysts. You can share ideas and get daily insights directly through the app. You can even join me in the community to see what I'm following. Now let's get back to the issue of margin. While a sudden tank in employment is horrifying, it's nowhere near the level of impact that margin has. Margin is when investors take out loans to purchase investments. Taking out margin doesn't sound too bad in theory, but the concept is extremely risky in practice. Imagine you put $50 in your brokerage account and take out $50 as a margin loan. If your portfolio goes up by 60%, your assets are now worth $110. On the flip side, if your portfolio goes down by 60%, your assets will now be worth -$10. That's right, -$10. Your portfolio wouldn't go to -$10 in actuality because of margin calls. A margin call is when your equity drops below the required percentage of your portfolio. A margin call will force you to deposit extra money into your account. If you don't do so, then the broker will sell your positions without warning you and charge you extra fees. Margin works extremely well on the upside, but is even worse on the downside. We are currently in the largest margin bubble in history. This is because margin has become even riskier than before due to alternative investments like options and futures. Single stock option trading volumes have increased to record highs during the pandemic. The total options trading volume in early 2021 doubled year over year to almost $600 million. Single stock options volumes are now larger than the volume for normal shares. This means that more people are trading options than stocks. Futures trading has also followed a similar exponential trend as well. Due to increased volatility from alternative investments, margin calls will occur very easily. When one investor gets a margin call, asset prices drop as the broker sells their assets. This causes others to get margin calls, leading to lower prices and even more margin calls. To make the matter even worse, credit card debt has exploded as well. Credit card debt has exploded over the past 5 years to over $4.6 billion. The reason why credit card debt has skyrocketed is that credit cards are simply too easy to obtain. Goldman Sachs is notorious for being involved in financial fraud, and it's no surprise that they're involved with the credit card bubble. Burry warned, Goldman keeps stepping in it. AIG was rescued to save Goldman from the other subprime issue that everyone swore would not be contagious. Goldman's Apple Card, more than a quarter to subprime borrowers, 3% loss rate on that business as of Q2. The Apple Card is far too easy to get approved for. Over 25% of Goldman's credit card loans have gone to people with credit card scores below 660. That's considered poor quality in the credit market. As I covered earlier in this video, inflation is a regressive tax, meaning that the lower class is going to be hurt the most. Goldman has been giving credit to many lower class citizens. As inflation increases, the same lower class citizens will be hurt the most. This is going to cause Goldman to experience unprecedented defaults soon. Once a customer misses a payment for 6 months, their loans are deemed charge-offs. Goldman's net charge-off rate is 2.93%. To put this into context, JP Morgan and Bank of America are only at 1.5%. The credit card bubble, in addition to the margin bubble, is going to cause a massive collapse in the economy. Burry explained how margin leverage isn't what it seems because of options. The volatility index isn't what it seems because of futures. Consumer credit isn't what it seems because of inflation. Quantitative tightening is exactly what it seems. Michael Burry is essentially saying that margin leverage, volatility, and consumer credit are all worse than they seem. On the other hand, quantitative tightening, which is when the Fed pulls money out of the economy, is as horrifying as it seems. Some people might tell you an entirely different crash narrative than Burry, but there are several reasons why they are always wrong. While Burry's track record is incredible, there are many other doomsday predictors that have been predicting a crash for decades. Burry doesn't believe they are entirely wrong. They just haven't factored in debt as a short-term solution to the issues they are discussing. Burry questioned, "Ever wondered why doomsday scenarios so rarely come true in your life on this earth? Because debt. Real and nominal GDP over total US public debt. In debt alone. The green line is the real US GDP divided by the total US public debt. You can see how since the 1970s, this ratio has steadily gone down. The same can be seen by the nominal GDP divided by the total US public debt. Total US debt is increasing faster than the total US GDP, causing the GDP to debt ratio to go down over time. This means that more debt is being created than actual economic value. The yellow line shows the total US public debt over time. While increasing debt works in the short term, the effects are going to be felt long term. Burry explained how no one knows how to measure or to predict consumer finance today. Consumers will take on a lot of debt if it is easy to do so. And credit cards, longer term buy now pay later, past and present stimulus/moratoriums, forgiveness, we just don't know how far all that goes. Neither does the Fed. With the three indicators that I discussed, Burry believes that the incoming crash could be worse than the 2008 recession. He explained, "Today I wondered aloud if this could be worse than 2008. What interest rates are doing, exchange rates globally, central banks seem reactionary and in SIA mode." One of my analysts said it was spooky that today I would wonder that Alpine anniversary. Some investors might question Burry's thesis. The stock market has fallen significantly, but it is currently nowhere near the level of the 2008 recession. The S&P 500 is currently down about 25% from its high. During the 2008 recession, the S&P fell by over 55%. Burry believes that we are not even close to the bottom of the crash. He explained, "No, we have not hit bottom yet. Watch for failures, then look for the bottom. 2 SPAC ETFs failing is not near enough." Michael Burry is frequently criticized for only betting on crashes. But while he mainly predicts market crashes, his track record is practically perfect. Burry detailed his predictions in a list. Crypto crash, check. Meme crash, check. SPAC crash, check. Inflation, check. 2000, check. 2008, check. 2022, check. As a result of Burry's inflationary thesis, he recently sold almost all of his stocks except for one stock. This video is just part 1 of a series covering Burry's latest updates on the market, so make sure to hit that subscribe button to see why Burry went all in on one stock. With the turbulent state of the markets, I like that on Public I can build a balanced portfolio across a range of different asset classes. Historically, opportunities to diversify with alternative investments have been limited to only the wealthiest investors, but now they are available through Public's platform. And for a limited time, when you sign up at public.com/cadsgains and transfer an account from another brokerage, you will get up to $10,000 depending on the transfer amount. See additional terms and conditions of this offer by following the link in the description. Definitely check out Public's investing platform, and thanks again to Public for sponsoring this video. If you enjoyed this video, please hit the like button and subscribe, and I'll see you in the next one.